Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled that you're here. And I know you're going to enjoy the gentleman we're interviewing today. His name is Jason Harris, and he and his wife, Carrie, have built up a $14 million portfolio on the side. But what's unique about their portfolio is it's all plexes, which is really kind of cool. They have 81 units, and it's all, for the most part, 2 to 4 units. So we're going to dig into how he did that, which I know will interest a lot of you that haven't started yet, and go from there. Welcome to the show, brother.
Thanks, Rod. Appreciate it. Glad to be here.
So let's have some fun. So talk about how you got started. Maybe why real estate? I know you're a financial planner, but how you got started and kind of bring us to present day.
Yeah, thanks. So Carrie's my wife. She and I started in 2010. We bought our first fourplex using an FHA loan. We wanted to partner with her mom and dad, who had a duplex only at the time, and they were trying to take that and do a 1031 exchange into a fourplex, and I wanted to get in on that if I could. I had very little money, but I was very eager and anxious. So I took them to dinner, had this big pitch on how I could add value and all of that. And they were kind enough to entertain the idea, but we found out later through their agent that her and I may be eligible to buy a property on our own. And that's when we learned about FHA, 3.5% to 5% down. And I had about $19,000 that I had saved up through school that I barely had enough to then close on our first fourplex. Within about 2 months, we had already made up our $19,000. At that time, there was the first-time home buyer credit of $8,000 that we got back, and then through prorated rents and security deposits and a couple months without a mortgage payment, we had already made back our 19 grand. And I then fell in love with real estate and thought, okay, this is something I need to figure out and do more of. And that's how we got started. And
nice. So you moved into that first fourplex then?
Correct. Yeah, we lived there, and the rent income from the other 3 units paid our mortgage, which helped us save a lot more than what we had been doing beforehand. We used that to improve the property and then also buy our next property, which was a duplex in 2014. We didn't realize at the time there were other strategies that could be used to acquire things more creatively, and so we were just saving up as quite quickly as we could to then put a down payment for the next property. And so that's what led us to 2014. We bought another duplex doing the same thing, owner occupied it, used a portfolio loan with 10% down and no PMI. And from there got more creative. Carrie got her license. And
let me slow you down. Let me slow you down so people that don't understand what you just said understand.
Oh, sure.
But let me circle back to that fourplex for 1 second. What a lot of people don't realize is if they have leases on the other units, you're able to utilize those to qualify, to help you qualify. They use 75% of that income.
Correct.
And so you bought that first fourplex, you moved into it, then in 14 you bought a duplex, and you did that one 10% down, and so that you didn't have any PMI, which is the mortgage insurance, guys. That's what he's talking about there. All right, please continue.
Yeah, and if maybe I can add to that, that the fourplex, for example, they do only count 75% of the rent income. I had gone to the bank and only had been qualified for $280,000. But then learned later that rent income helped me be able to qualify for that $435,000 fourplex. Otherwise, I wouldn't have been able to do it.
Right. You can buy a lot more than you're able to qualify for on your own, which was the whole reason I wanted to stop you there. So I'm really glad that we did. So guys, if you can only qualify for a couple of $100,000, you buy a fourplex and that you can double that amount. So awesome. So,
really?
And FHA has what's called private mortgage insurance, and it adds to your costs. So you were able to avoid that by putting 10% down, I take it.
Correct. So you typically can only have one FHA loan at a time, unless there's some qualifying reason. And for us at this point, we didn't. And so we found a portfolio loan from a local bank and credit union who would allow us to owner occupy with 10% down on a 2-unit or smaller property. And so because we wanted to receive as much income from our primary residence as possible, we went with a duplex that was bigger, 4-bedroom, 3-bath per side. and used that income to offset most of the mortgage once again. And then we're able to rent out the fourplex unit that we had occupied as our primary.
Got it. So only one FHA loan at a time. This is out of my wheelhouse now, so I'm really glad you said that. And so that explains the 10% down. Okay. And so you did a portfolio loan at a bank, or could you say credit union, was it?
Yeah, it was U.S. Bank, actually. Yeah.
Okay. Awesome. Big national bank. Wow. Okay. So you bought a duplex, and now you've got 81 units. What happened between then and now?
Well, we got a little more creative, and Carrie got involved. And I think that helped us understand you typically can only have 10 residential loans per person. And
per Fannie Mae, right?
Correct.
That's a Fannie Mae guideline, right? Okay.
Yes, and we didn't know any better, but we were putting Carrie and I on both of us on the loans.
Oh.
And so she was getting one loan, I was getting one loan, and we didn't realize that was counting for both of us. Right. She wasn't working at the time, so she wasn't really helping us any qualify for the property. And so later we refinanced her off the loan at 75% loan to value, just in a regular conventional loan. And that gave us back an FHA loan, but also allowed me to only count those two loans on me and not on her.
So that limitation doesn't apply even to married couples if you do them individually.
Correct.
Wow, that's interesting. I didn't know that myself. So effectively, you could have 20 loans between the two of you if you both have enough income to qualify.
And so we've done it a unique way, Rod. I have 10 loans in my name, all residential, and now we've shifted everything so that anything that's negative from a debt to income perspective, we put those loans in my name. So now Carrie, we can make her income as strong as possible so she can get her own set of 10. And so that's how we've acquired 2 units here, 4 units there, and it's continued to evolve.
So just guys, just so I want to make sure you caught what he just said, okay? And when you're working like he's doing on these smaller properties, there's positioning involved, and you're basically positioning yourself in the most positive light for financing. And so, like you said, you take those underperforming properties, you put them in one person's names while the other person is qualifying for additional acquisitions. Oh, that's brilliant, buddy. I've done it myself. That's brilliant. Okay.
Yeah, no, thank you. I think that's when things clicked for us. We were putting 5 to 10% down every time because we were a young family owner occupying the units. And we realized that if Carrie was the agent helping us acquire these properties, I could let her still stay at home with the kids, but make an income on the side. And every time I purchase something, we're improving her income so that in the future, she now has an income on our tax returns, which would allow her to then qualify for her own set of loans. And so over the next few years, we continued to purchase property. And every time I bought something, it made Carrie income.
Right. Just so guys, we want to be real clear. She got a real estate license. Okay. And so she's an agent, so she gets a commission. And so, love it. So every property you buy creates income for her to help her qualify down the road.
Absolutely.
Just so you guys, I want to circle back just so they get everything we're saying here. And I've done the same thing. Absolutely the same thing. Purchased hundreds of houses in Denver, and I was a real estate broker. And in fact, back in the day, I'll just digress for a minute. VA used to offer houses that were in foreclosure, and I would get a commission on them, and investors could buy them. So not only did I get a commission, I could actually buy them. It was a beautiful thing. I wish those days would come back. But so you're basically capitalizing on all these different aspects. The Fannie Mae limit, the income from your deals. So not only is that helping her qualify, but it's also reducing the amount of money you're paying for these properties. So that's a nice strategy where a married couple, one of the people has a real estate license. Love it. And that would be the only reason, by the way, I get asked all the time, should I get my real estate license? I say no, because what it does is it actually raises your accountability to another level. You're held to a higher standard, and there's just no benefit unless you're actually going to sell real estate. Well, this would be the one example where I would say, yes, absolutely. It makes sense. But if you're just going to invest for yourself and you don't have a spouse, then I wouldn't do it. But in your case, it's brilliant. So
and I concur, with all that you said.
Right.
It's interesting because we were young. I wouldn't say struggling, but we didn't make a lot of money. But through these types of strategies, we were able to build up Carrie's income to a pretty sufficient amount where she actually makes more money than I do now because of the volume of properties we purchase, and because now we're recognized by many in our area of people who understand how to acquire investment property. And so she has started to represent people over the last couple of years. And
Sure. So it's given her some notoriety. Love it. So let's talk about how you're finding deals. Are you still able to find deals, and what are some strategies you've used to find these plexes?
That's been real difficult, Rod. It's becoming harder and harder. There's been limited inventory, but we've found kind of areas that we really like, that we already own property in, or that tend to cash flow better than maybe other areas. And so my wife and I have actually door knocked those neighborhoods. We've sent others out to door knock them and just paid them for their time. We've done mailing campaigns where we've targeted those specific areas that if I know they're in that zip code or neighborhood, I'm going to be interested in buying their property. Once again, Rod, going back to if I can find it off market, I may be able to negotiate a buyer's agent commission of 5-6%, and that's not going to be any less to the seller because they'd have to do that anyways. I think when you're younger and you don't make a lot of money, it took us 4 years from 2010 to get our next property in 2014. The velocity of money concept was slow, and we wanted to find a way to accelerate that where we could take the capital we've put into the property and get it out faster so that we could go and repeat that deal over and over again. And so as we were able to get more creative and start getting higher commissions, we had less of our money tied up into each property, which then allowed us to go repeat. And so
Super.
Over the last 4 years is where we've really seen a lot of acceleration to our.
Well, let me enhance what you just said, because as far as the velocity of money, actually, let me circle back for 1 second, because I want to circle back to what you said about door knocking and mailing. Guys, those are examples of doing what other people aren't willing to do. And anytime you do what other people aren't willing to do, you'll be a success. I mean, that's how I bought hundreds of houses in Denver, knocking on doors of people who were in foreclosure. I've got a coaching student right now, Matt, that, got a list of the people in his community that owned for 20 years, found the people that live locally and knocked on doors. And he's bought 3, a 6-plex, an 8-plex, and now another 6-plex that way, just by knocking on the doors and saying, hey, do you own that property over on XYZ Street? Now he owns them. So, mailers, of course, work. So I want to hammer that point home. Don't be afraid to do what other people aren't willing to do, because that's how, you become successful. But the second thing, as far as the velocity of money, I know that, you've become creative, but, and that's why you're up to 81 units. And I will tell you, it's not just being creative. It's also enhancing or expanding your personal financial kind of, what's the word I'm looking for? The box that we put ourselves in financially, being willing to go larger and larger. But also, didn't you tell me that that you're also now bringing in partners, that if you don't have the money, you'll bring in somebody to put up the money, get the financing, and split the deal?
Yeah, absolutely. So we talked about a little bit, I hit my 10 loans that May was allowing me to have. And so we found these 2 duplexes off of a mailing campaign that I thought were great properties, but I couldn't get the loans, and Carrie wasn't yet loan eligible. We needed 1 more year of tax returns filed before she could do it herself. And so I didn't want to lose the deal. And so I actually called friends and family and those who I knew maybe had good credit and capital available, told them of the opportunity, explained the numbers, and asked if they'd be interested actually in financing it. And then I would pitch in 50% and we could own it together. I'll help manage it and kind of be the brains behind it all. And after looking at it, they liked it, they bought it, and we had a 6 and a 7% commission, buyer's agent commission.
So no money out of pocket.
And so luckily we came up with our 50% through the agent commission, and those properties cash flow well and have several hundred thousands of equity now. And so it's been great for them too. We've been excited on a number of ways.
This is deja vu for me, brother, because this is exactly, I bought tens of millions of dollars worth of houses in Denver this way. I put up half the money, but it was through my commission. 50-50 deals. Sometimes I didn't put up any money. Sometimes they put it all up. In fact, many times they did, because they were happy just to get half the deal by putting up the money. But this is being creative, guys. And I love that, that we're having this conversation, because I don't think it's ever even come up on the show before. And this is how you get started. And I know you're thinking bigger things now. Correct, Jason? I mean, you're thinking larger deals now.
Yeah, we're getting excited. We have a 10-plex I was telling you about, but we also have a commercial project that's about 1.5, 1.6 million. But it's a value add opportunity that we think with just a couple $100,000 of capital could be worth 2.5 to 2.8 million based on comps. And then we also may go under contract today. We're hoping on 60 units in another market that we haven't yet been a part of, where I'm exchanging 3 of 4 plexes here for 15 4-plexes there. And
nice.
It's cash flow 3 times better. The appreciation, obviously, and principal reduction will be significantly greater than what I'm currently getting.
So you're gonna basically position some of these smaller properties to get into a larger deal, and that's a very common progression. Now, I would tell you, I would hold on to your properties wherever you can, and just bring in outside capital to do your deals. And because frankly,
we're working on that too, Rod.
All right, good. Because in my opinion, that's how you scale. That's how you really scale. To do the really larger deals, and you just exponentially ramp faster. But now you've done really, really well, and I love these creative strategies. So let's talk about some of the speed bumps. Let's talk about some of the stuff let's talk about some of the times you got your nose bloodied in this journey of yours.
Yeah, one thing that comes to mind is how difficult it was to get loans after the 2008-2009 market crash, which was a big reason why we had the crisis all to begin with. And so we really had a hard time with our income level to get qualified for loans at times. And so we had to be very conscious of what we deducted or didn't deduct in order to keep our debt-to-income ratio strong enough for the banks to keep giving us loans. And so I learned in time that if I sat down with my CPA, did my taxes, before filing and sending them off, I would send them over to the head underwriter of the lending company that I use most often, make sure they go over it and make sure I didn't depreciate or deduct something too much that then now kept me from being loan eligible. And so they would make some adjustments or changes or recommendations, send them back to my CPA, who would then approve those, and then I would file. And sometimes maybe I'd lose out on $1,000 of potential tax savings, but in essence, that next year it gave me the opportunity to make tens of thousands, if not hundreds of thousands, on properties that I could acquire that otherwise I wouldn't have been eligible to get a yes from the loan officer. And
sure. No, that's very interesting, and it's very prudent on your part to make sure that you weren't being too aggressive on your deductions to hurt yourself in the qualification process. And that's very smart. Now you did all this on the side, right? I mean, this is pretty much, you've still got your financial planning business, so you've got a day job,
right?
And now you've replaced that income. But talk about, you have children as well, right?
Yeah, we have 3 kids.
3 kids. You're married. You've got a full-time job, and you did this on the side. And I'm saying all this because there are people listening that are wondering how to do it on the side, and I want to point out the fact that you did it on the side. So, talk about the motivation and the strategies that you might have used to be effective and build this respectable portfolio on the side.
Well, it started all from the beginning. We bought that first 4-plex. And I was young, I was 24. I wasn't making a whole lot of money. The rent income from the 3 units that we lived in was about as much as I was making at my day job, where I was exchanging 40 to 50 hours a week of my time. And all I had to do to collect that same income was show up on the first of the month and receive a check from my tenants. And so I fell in love with the idea of all I need to do is acquire more cash flowing properties as soon as possible, and I dictate and control my time and income. Now, there's no limitation to it. And so that's where it all began, where I need to figure out a way to acquire more and as many as I possibly can, as soon as I possibly can. And that was the recipe. I just didn't know then as much as I know now, and there's many things you can continue to learn.
You knew the what, you just weren't sure on the how yet.
Correct, absolutely.
Awesome. Yeah, I had this, again, deja vu again. It was like, why aren't more people doing this? I mean, there's cash flow. There's, you were able to do it. So Do you manage your own assets? Are you managing these 81 units yourself?
So we started out self-managing. I recognized from the beginning that wasn't going to be a good recipe. I would spend 3 hours tinkering around trying to fix something and only make the problem worse. And so at a very early stage, I realized I need to make sure my properties profit or cash flow enough that I can hire a professional to do that who's licensed, and he'll come back and fix it if something goes wrong later. And so we started out probably our first 3 properties. We had 8 units. We were self-managing. But because I had a daytime job, that was becoming too time consuming, that we had to hire that out. Interestingly enough, though, now my parents work for me full time and actually manage all my properties. So they quit their full-time jobs and now work for me. And it's worked out a lot better that way too. And
so you still have the management in-house. You just hired your family to do it. Interesting.
Correct.
Okay.
Yep, absolutely.
Okay. Well, that works. And, once you have enough of an infrastructure to do that, I mean, those of you listening, ideally, and you don't always have this luxury, but ideally, I recommend third-party management while you're in acquisition mode, just because you just don't have the bandwidth to deal with toilets. But it sounds like you've put together a nice little team. So, what do you think is the most challenging part now of what you're up to? Is it finding the deals?
Well, yes. In our particular market, South Salt Lake City, our inventory is so low, it's hard to find anything that'll even positively cash flow unless you're willing to put 40% down or more. And that's not fitting the criteria of what I want to do in order to scale. And so we've started to research in other markets, which is kind of where I told you we're looking at other property in other states that cash flow better than what we do here.
Okay. What's some of the best advice you've ever received about this business?
Oh man, I don't know how to identify it to one.
Okay, well, you can do more than one.
I think what I'd say though, Rod, is I've learned that you don't have to make a lot of money to get into real estate.
Right.
To accumulate wealth, it's not about how much you make. It's about how much you keep.
Right.
And what you keep, how hard it's working for you. And I didn't make a lot of money in my 20s. I really didn't. I did okay as a financial advisor, but we were millionaires before the age of 30 on paper because of equity we had amassed in our real estate portfolio. And what I saw that growing to year over year over year was substantial, that you can't save your way to wealth like you can when you own real estate that's leveraged, that we were doing. And as long as your cash flowing and your profit margin is strong enough, and you're prudent in having reserve money in case a bad economy or a bad cycle hits, I think it's a great recipe that you just can't do in other asset classes. And so I'm so excited that we started at a young age. I thought that you had to have a lot of money to put down in order to start. And we didn't, and we made that happen, and we've learned how easy it is to start even when you don't have a lot of money that you make.
Love it. Love it. I know you're getting ready to do larger deals. You're absolutely welcome to come to one of my 3-day boot camps where we dig deep on syndication and, find and doing larger deals. In fact, we just put a $17 million deal under contract today. Let me ask you this. Knowing what you know now, is there anything you might have done differently? What would you tell your 20-year-old self when you were first starting? What might you do differently?
So I was highly aggressive, Rod, from the beginning. And so my appetite to make it happen probably couldn't have been much greater than it was. But knowing now how great real estate's performed, I think I would have been a little more courageous to try to ask for capital or borrow money sooner. I felt like I had to prove myself a lot more before people would trust me to actually partner on something.
Oh, I'm so glad you said that. I want to stop you right there for a second. Guys, this is a common mindset that people have, is that, you know what, I can't go ask for money till I actually have a deal and prove that it works. And guys, you do not have to do that. You can first of all, you can accomplish that by aligning with somebody that's done it. That's an easy way to do it quickly. But even then, real estate's proven. So I'm really glad you said that, Jason, because this is a very common misconception that people have. And, I have coaching students who are like, you know what, I'm just going to buy a 10 unit before, so I can show people that it works. You don't have to do that. you'll get, there's so much money looking for deals right now. It's crazy. I mean, on the sidelines, because deals are harder to find right now. We're at the top of a market cycle. But I also want to circle back to something else you said, and that is it is critical to pay attention to cash flow. You need to stress test your deals. You need to make sure that you can weather a pullback in occupancy and weather a decrease in rents and all of that. But
and maybe this is a tip too, Rod, for some of the listeners, but what we're trying to do to protect ourselves from that, I'm a financial planner, and so that's something I teach my clients all the time too, and in other areas. You need to have reserves for all the properties. Typically, the more you have, the larger percentage that the banks are going to require for financing reasons even. And so in order to continue to scale, you have to have other assets. And so something that comes to mind, we've been funding our Roth IRAs and Roth 401ks for many, many years because those assets can count as reserve money.
Cushion. You bet. You bet.
And I've already paid the taxes on them. And so the accessibility to that is a lot better than if I was doing a traditional or SEP IRA or 401k. Furthermore, depreciation is one of the greatest reasons one should be investing in real estate. And I didn't mention this earlier with financing. I learned that I could still get great tax savings year to year through depreciation, but then the banks can add depreciation back because they realize it's
qualify. Yeah, because it's a paper loss. Yeah,
I have a stronger and stronger income every single year, but my taxes have remained really low because of depreciation. And so I learned I don't need to highly deduct everything from my business that really costs something if I can use depreciation to still get the tax savings. And I also can forgo the deductibility of traditional IRA and 401k contributions because my tax benefits I'm getting from the depreciation of my real estate. And so I'm funding a great vehicle also in retirement accounts through Roth accounts that grow tax-free. And so in some ways you can say they work hand in hand. My cash flow is building on my real estate that helps fund my retirement accounts, that also creates reserve money for future deals I want to buy in real estate. And if needed, someday it may be the one funding my real estate deals because it's tax-free and it's accessible. And so I just love that they work hand in hand and very well together.
Beautiful how it all works together, isn't it?
Yes.
And you did a great job in articulating it, by the way. Thank you.
Thank you.
Well, listen, my friend, you've added a ton of value today. I'm very grateful that you were on the show. And, I appreciate your time. And I know that you've inspired a lot of my listeners because, guys, I mean, here it is again. And you've seen numerous examples of huge, players in the space that have thousands of units. And here's a guy that did it one duplex, fourplex at a time. And now you've got, you're able to, you quit your day job and go on and do these larger deals. And you did it, like I say, one plex at your time with mostly your own money. Very inspiring, brother. Thanks for being on the show.
Thank you, Rod. Looking forward to your 3-day event. I'm going to check it out.
All right. We'll make it happen. All right.
Hey, thanks so much. Take care.
All right.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.